Okay, welcome everybody. Welcome to session number 5 of the Hudson sessions. It's going to be a bit of a different presentation today. I'm going to spend a lot of time. It's going to be a very applied presentation. We're going to spend a lot of time looking at patterns that illustrate the concepts from chapter 5 of the book. Now, chapter 5 of the book was one of the more difficult chapters to write, I will tell you, because it's relatively easy to understand and to talk about and to write about trading ranges. Relatively easy to understand trends, but the very complicated areas where trends become ranges and ranges become trends. Of course, if you could predict those areas with 100% accuracy, you'd never have losing trades. And the reality, obviously, is we cannot do that. So that highlights how, I'm sorry about the background noise here, but that's the urban soundtrack, as I call it. That highlights how complex, how difficult, and how challenging these areas are. The way most books have traditionally treated this is to just kind of give optimistic answers, or to boil it down to a handful of patterns and to say, you know, you're looking at this relationship of swing points or this kind of momentum, and then, you know, just look for this and you'll magically have winning trades. But the reality is the market's a lot more complicated, and I had to capture that in the book in a way that was not overwhelming. Today, I don't have the second constraint. Today, we can be a little bit overwhelming. So we're really going to go into so many of the issues that you would face trading this in real time. And I'm guessing for those of you who have some real trading experience, you probably over the years have experienced some significant frustration around these areas. So, you know, hopefully we'll start to untangle some of that. While I said this is a very applied presentation, we're starting in we'll start with something that's a little bit out there. Think a little bit about about how we perceive things. I want to recommend a book I've been reading that I think is super interesting and relevant. Talk a little bit and raise some more questions about the whole nature of reality. Before we really get into this trend and range stuff, which is why we're here today, I'm going to spend quite a bit of time talking about Climax. I have teased this over previous presentations. You know, I've said, okay, here's kind of the structure, and we'll talk about it in detail later. Today is the day where we talk about it in detail, but I think if you missed those previous presentations, it's worth going back and looking at those if you want to understand these areas in detail, because there's a method to my madness here. I deliberately built in different views, and the repetition in the book and also in these presentations is quite deliberate. So let's start first of all by thinking about perception. And if you just think about how we live our lives, we have to have kind of some ground level assumptions. We can't, every time we see a pencil somewhere, we can't have this massive philosophical discussion with ourselves about the pencil, or we would not be able to function in the world. So the reality is we do have lots of shortcuts, but it's worth thinking, heuristics, if you will, it's worth stepping back here just for a moment and thinking about seeing, wondering that if when you do look at that pencil, are you seeing the pencil as it is? There's also a philosophical and psychological argument for the idea that we see things not as they are, but as we are. And I think that's certainly true of the social environment around us. It is also profoundly true about the market. So this is, you know, if you come in, I can tell you with pretty much 100% reliability, if you come in as a day trader in the morning and something is wrong, you maybe had too much fun last night, you don't have any sleep, you had a fight with somebody in the morning, and for some reason you're off balance, that's going to translate to your read of the market. A lot of times we see traders who do super self-destructive things, and we say, how could they do something so dumb? Why would somebody do that? Well, the reason is not because they're deliberately trying to do something harmful, but because they're acting on their own skewed perception. It's absolutely worth spending some time thinking about how our perception might be unreliable and how our perception might be skewed. And I think to really do that, we have to think about what everybody's calling the hard problem now, which is basically, how are you right now even able to be sitting there listening to me and thinking all of these, have this consciousness in your head? How is that even possible? And this is the problem that, at least as far as I know, it's a problem that I followed with the work on it with quite a degree of interest, if not professional skill. We don't really seem to be making much headway there. And all of the neuroscience answers kind of collapse into, we don't really know. And so then we're left with all of these philosophical questions about what, which basically ends up that what is anything after all? And these do seem like, I don't want to, we could talk about this particular slide for days. I don't want to do that. I want to get onto the trading stuff, but I would encourage you, if traders cover the complete span of humanity, of course. And if you're one of the people who just really focuses on things you can see and touch, and metaphysical questions, that just means things that we can't really wrap our heads around or define. If those questions don't hold any interest at all for you, it's worth, as traders, thinking about those things, because when you start to develop some clarity there, or at least confronting the problems there, it does some interesting things for your trading. At least it has for mine. Two modern answers to this "what does anything mean" question. One is simulation theory, and a lot of very smart people are talking about this idea, and people have come up with math that shows that the probability that we're living in a simulation is something close to 100%. And this seems like cutting edge thinking, right? All of the, we have all of the video games, and it's quite easy to extrapolate that idea to every aspect of reality. My thinking with this, and I don't really hear other people saying this, I don't think there's anything new here. I think what we now have is a language of silicon chips and memory and graphics processors that we can now define a simulation in a way, but we just have different language. We have a different wrapper to put around this. And if you sat down with the ancient Greeks and talked about the nature of reality, they would understand the simulation theory quite well. They'd be confused about the mouse, they'd be confused about computers, but they would absolutely understand the concept here. So I don't think there's anything that new or, frankly, that incredibly interesting here. But one of the interesting new things that I have come across is this book that I'm going to suggest you track down and read. And in fact, maybe can you guys drop a link, Betsy or Tom or Annika. By the way, I do have a team here with me today helping to field questions. So type your questions. I'll remind you as we go along. Type your questions in the question box, and I'll try to get to them as we go through the presentation. But look up this book, Donald Hoffman, The Case Against Reality. Let's dig into this a little bit. So Dr. Hoffman's point is that he goes through some game theory thinking, and I'll just point out here, maybe arrogantly, where I think a couple of the mistakes might be in this work. If you model the evolutionary process and you have only two possibilities, one is that when our perception, let's take visual perception for now, that when we see something, that is true. What we're seeing is a complete realistic representation of the thing that's out there. And then the other scenario, the other case, is that it might not be true, but it might be useful. So this is his argument is against fitness only, meaning that evolution selects for what allows people to survive. For instance, one of the concrete ways this might manifest is that you perceive that apple, which is a food source, and you perceive it as having a certain shape. It doesn't look rotten. It might smell appealing. It has a certain color. And those colors, those perceptions might not actually be real. They might be a signal that says, in terms of fitness, it would be a good thing if you ate that apple. It would be, it would sustain you. And even the distance, where this gets really weird, is how far away the apple is might be a reflection of how difficult it is to attain that, to grasp the apple. And you can see that in the limit, this gets kind of crazy, and you start questioning the reality of space-time, which is, that's something we could do too. But I'll let you read the slide. I won't read it to you, but his claim basically is that there's essentially a 0.0% probability that evolution selected for truth, meaning that everything you see is likely, in some sense, a mistake, a lie, an inaccurate representation. But here's where this gets interesting, and here's where this starts to get pretty practical for traders. That apple scenario with the, your perception of how far away the apple is or how high it is, in some way reflecting how difficult it is to get that apple so that you can eat it. There's this idea that reality functions as an interface. Now we're starting to see how this might actually play in quite closely with our perception of the market, right? And you might say, but this seems silly, because I know if I walk over there and if I reach out my hand and if I grab the apple and I eat the apple, all of that matches my perception perfectly. So how are you telling me this isn't true? And in the book, he gives very interesting connections to well-designed user interfaces. Think about if you are on a desktop and you drag a folder to the trash can. Now, what's actually happening behind the scenes, we know how pointers are getting moved on the disk, and depending on the kind of disk, we know how storage works, but nobody really thinks of what's actually happening is some hand is picking up this folder and dropping it in the trash can. But you see it and you perceive it, and that's a reflection of a well-designed interface, which you could make the same argument with reality. The point here really with this is that you certainly don't see everything that exists. And again, read the book, because he then does go into why space-time very well may be on the way out as a concept. This is, as I say here on this slide, it's a reminder that what we perceive is very likely not real, and that is almost certainly true. We've encountered this in basically every presentation we've done here. This is presentation number 5. Every 1, 2, 3, 4, there were moments where I reminded us, sometimes quite brutally, that what you think you are seeing when you look at the chart, when you look at an order book, when you look at a market profile presentation, what you think you are seeing is not actually the thing. It's a representation. It's a model. It certainly loses fidelity. The other interesting piece of it, and that can be very discouraging. I remember when I was a new trader, and I started to realize, hey, there are ticks missing from my charts. So there are trades happening that I'm not seeing. Just as one example, I'm not seeing the whole thing. That was really wow, very discouraging. But the point is that these interfaces we have, this perception we have, is useful. It is, think about the selection for fitness and Hoffman's idea. There are also, here's something I do want to share with you. This is kind of a cool optical illusion, because I do think that this plays a part in the market, this idea of optical illusion. Take a look at this while I'm speaking. Look at these. Of course, there is no actual square on your screen, but look at this for a moment and see, do you perceive, I'm going to draw and then I will erase the lines. Do you perceive glowing lines here finishing out the square when my marks aren't on there? Sorry, I lost my train of thought with that explanation. So this is this is kind of like a built-in error correction system that your brain perceives there's a square here. And of course, if we go over here and we cover up some of the squares, you no longer perceive this kind of glowing band. It's interesting. This is a subtle optical illusion. Some optical illusions hit you over the head. This, however, is right on target with some of the things that happen to us as traders. One of the persistent optical illusions for traders, I believe, is grid lines on charts, horizontal in particular grid lines, because these tend to print at round numbers. And so what they do is, and we've looked at this in previous presentations, if you just draw any line on a chart, it's a very similar mental trick that's happening here. You will perceive that line to be important. There are many, many more for those of us who focus on charts. And if you're a quantitative trader, then you have a slightly different path. But if you're a trader who looks at charts and tries to understand patterns, you need to be respectful of optical illusions. Look at the screen again and think about this differently. So imagine now that the background is black and there is the squares printed on the black background. This one's a little harder to see. You might have to play with this. I won't spend a lot of time here. And now imagine that you're looking through a piece of paper that has 4 holes in it. If you switch your brain to that way of thinking, you will no longer perceive the glowing lines there. And then you can look away and look back, and you can pause this or buy the book and look at it in the book. You can play with switching your perception back and forth. We could spend a lot of time on this, but the point is there's a lot more going on both in the market. There's a lot more behind what we actually see than we possibly could know. Our perception includes some built-in error corrections, many assumptions, and this boils down to many well-known optical illusions, but I think there are many other things that play a part in trader perception over and over and over that we're not aware of. It's also worth spending some time taking these 2 words apart, useful and true. Now, let's switch gears here a little bit and let's look at markets. So today, I'm going to show you many charts, and I'm focusing on daily S&P 500. Now, I know there's a tendency, because I've been there, to say, you might say, well, I only trade currencies, so this presentation isn't gonna, it's hard to get involved with markets that you don't trade. But and it is true that other asset classes have slightly different characteristics. For instance, currencies don't really have gaps, because a currency chart is kind of an artificial divide, whether it's the New York close or the London close, you pick a point to be the closing print, and then you start the next bar. So it's very unusual for currencies to have gaps, except over weekends when the markets close by convention Saturday and Sunday. We will see a gap sometimes from Friday close to the Monday or Sunday night overnight open. So there will be gaps. So there'll be a lot more gaps in stocks. As futures trade more and more 24 hours, there are fewer gaps. There are also some differences in mean reversion. There are some differences in volatility. Volatility in currencies tends to be a little bit more consistent. So my point is that there are some differences, but these patterns apply. And the reason that I chose the S&P 500 is, first of all, it's one of the markets that I watch very closely, multiple times every day for decades. It also is certainly one of the most important markets in the world. But more than that, if I want to illustrate some pattern lesson, and I'm going back through the several years of the S&P, and if I can't show you definitively that this pattern works on that data, then it's probably not a very universal pattern. So I should have been able to do this, and in fact, I could have done this with any market. If you have, this is quite different than tuning a trading system for a specific market. That's a different approach. But if you want to understand broad structures, concepts, underlying concepts of how the market works, then we really should be able to tease this out of any market that we look at. Take everything we do here today as this is not the final answer, but I hope it's provocative. I hope it will make you go do your own work, do your own research, even if that is, if you're a casual investor, maybe spend half an hour looking at charts and trying to find these things yourself. If you're a more serious trader, then you can indeed get quite serious with this and spend many, many hours looking at this work. Let the sirens pass a little bit. So turning our attention to Climax, we have talked about this, as I said several times. The concept here that makes this very easy to understand is to think back to Wyckoff's composite operator or composite man. The idea that even though there are bazillions of people trading in the market, that we really can think about it as a buyer and a seller, or a small group of buyers and sellers, and we can think about price action in terms of their conviction. When one side dominates, so good price action, a good trend, whether it's a 10-year bull market in stocks or a 5-minute move in a currency, a good move is sustained by dissension, disagreement, and perhaps even confusion. So, you have people that say, okay, this thing's a good buy, and then they buy it. I don't know now, and so then they sell it. Yeah, but people sell less than they bought. Now more people say, oh, look, it's getting cheaper. It's time to buy it. That action, that premium, we've talked about this producing like the waves and the pullbacks in the market. But where things get very dangerous is when we get to a point of consensus, when everybody looks at the thing and says, yes, it's going to the moon. It's an absolute buy. This is why you hear these, kind of seem like nonsensical ideas, but the idea that, like, if you get in a taxi cab and the taxi driver asks you about the market, the move's probably over. And that, or when it appears on like the cover of USA Today or something like that, on a non-finance publication, when everybody's talking about the thing, by the time it's in the case of a big trend, by the time it's bubbled up to be at the top of the collective mind, it's probably over. And we certainly can zoom down and see this on charts, which is what we're going to do today. The problem with this is that what you will see on a chart, when everybody agrees that the thing should be bought, it will likely be going up quite well in a very clean trend, and it will look really good. And this is a point that is, if you think about everything we do as technical traders, is we learn to judge that balance of buying and selling pressure, right? That's really what it's all about. It's not about these silly patterns. The silly patterns are only there because they help us understand this balance of buying and selling pressure. So if we develop that sensitivity, then it's very easy to be misled when a market looks really strong. In fact, that's, when it looks really strong is when we should be most bullish ourselves, unless you understand this. A lot of trading mistakes come from misunderstanding Climax. But my point is that your struggles, your frustrations with Climax areas is honest, it's legitimate. My very first trade was buying a grain at the absolute peak of a Climax move. It looked fantastic on a chart because I didn't know any better. And if you haven't done that yet, you probably haven't been trading long enough. But maybe you can avoid it after today. So also, there is a little bit of philosophy here. Maybe the I Ching, I think, expresses this most clearly, that the language there is the fullness of yang contains within itself the seed of yin. So when something gets to the point where it's reached a complete extreme, it's natural for things to swing back in the other direction. This is why philosophically it is useful for a trader to think about some more Eastern conceptions. What do I mean? On a philosophical level, my understanding is perhaps the main divide between the East and the West is that the West tends to see things in a linear way, that we started someplace and we're progressing. History is a progression through to something else, where Eastern religions tend to see things and philosophies tend to see things as more of a cycle. that, okay, we've been here, we'll be here again. And, I think the reason it's a little bit difficult to untangle reality is there's probably an element of both of those things. But certainly in the market and in anything having to do with human psychology, rage exhausts itself back into something else. Depression often exhausts itself back into something else. Sometimes these things need nudges, but it's kind of the natural cycle. And it certainly is the case in the market that extremes, bullishness, bearishness, extremes of volatility. We are at a relatively low point as I'm speaking here near the end of July 2023. We're at a low point in volatility in the stock market. And what tends to happen from those points is volatility increases. When volatility gets absolutely crazy, it tends to decline. So the cycle goes on and on and on in all ways. Mechanically also, there's a vacuum on the other side. So think about Wyckoff's buyers and sellers. Let's think there's a small handful rather than millions. And if everybody is, what moves the market is people changing camps. If you have somebody who is neutral that then becomes bullish, they're going to express that view by buying the market, right? And at some point, if everybody is bullish, now of course in reality everybody is never bullish, but conceptually, let's speak in models and be a little bit sloppy here. If everybody is bullish, then there's literally nobody left to buy. And if everybody is bullish and everybody has bought their full line, they bought as much as they can possibly buy, what's left? What's the only possibility is for somebody to sell. And that selling action is going to move the market down. So we do see this in these climax points when, and I'll show you here on a chart in just a moment, when everybody is as bullish as possible and the market makes a small move down, it just collapses. And the same thing to the other side. Now, how do we identify these areas? So it's never everyone, it's always on a spectrum. And this is one of the challenges here, that it's not like we can flip a switch and say, this is definitively climactic. What we can say is this area has the potential to be climactic, or this area has more potential, or even in some cases, this probably is. How do we do that? So one idea is that climaxes usually come in a mature trend. They can come earlier. You can have just a single, you could have a market like, you might argue that, and this is not really in the presentation, but imagine a failure test where you have a resistance level, market goes up above it, and then is slammed back down instantly. You might argue that that move up was temporarily climactic, and you would be right, and you almost certainly would be right if you were to zoom down to a lower time frame. You absolutely would find that. But most of the climaxes that we see that are tradable come in a mature trend. So that's one warning light. Now, of course, you can have a mature trend that becomes more mature and more mature. And if your mindset is completely set on fading that trend, you can lose all of your money fading a 10-year trend in stocks like people have done, unless you write newsletters and you're perma-bearish, and then you can be famous. But you can't trade on it. It's absolutely worthless advice. Maturity of the trend is not the only thing that we need to look at. Acceleration in the direction of trend. So what I mean is you have your market trending along like this, and then it starts to trend at a higher rate. And this is also sometimes called a parabolic price move. And the reason I think it's called a parabolic price move, everybody will show this, but I think the assumption is that then it will look parabolic on the other side. And sometimes it does or not, but there are specific patterns we can look at. These patterns into exhaust, free bars, keep an eye out for these. 3 pushes, which is an idea more than a specific pattern, because it can be 4, it can be 3, and then 3 nested. I'll show you all the, not all, but I'll show you many complex variations. And one of the really nasty things is, and I think this is what got me for my first trade, you have a market that's trending, and then you have like big bars at the end of the trend. And if you've been waiting for a signal to buy and you don't know what a breakout looks like, you'll say, oh, those are big bars breaking out to new highs, so it's a good buy. That is classic Climax. So what does Climax look like? Well, look here. This is, I'll try to point out the timeline here. So this is late 2017 into 2018. This is one of the more standard examples of Climax I've ever seen. Let me just kind of sloppily, these are internal trend lines, but I want to make the point here that the trend continued to accelerate. Look at that, each one of these, and we could draw formal trend lines here. I don't want to like stare at the chart to do that. But you can see the rate of trend increases. This is a quite extended trend. It's been going on here for a while. Note the free bars. So here the market is, what I mean by a free bar is you have your bands, and these are set a little bit differently than the parameters I gave in the book. It truly does not matter. You have your bands around a moving average, whether they're Bollingers or Keltners or whatever, and a free bar is a bar where the low of the bar is above that upper channel. So it's completely outside the channel. With most channels set properly, you're not going to have a lot of free bars. Now, I've contracted mine, so I will have more than you will see using the settings that are in the book. Here's a little run of free bars, but you see they're still unusual, and it's a warning of potentially climactic moves. Also, look what happened here. Look at the ranges, just eyeball it. Look at how vertically, like how big the bars are here, how big they are through here. Yeah, there's a few big bars in there, but then look, like all of a sudden the bars get pretty big, right? This looks really great. Well, unless you don't know that this is a classic setup for Climax, and we did in fact then have a collapse into the other side. So when you're looking at an extended trend, do remember it's possible in breakouts, but I think you need to be most suspicious of Climax after an extended trend and you can just use have the build into your thought process. If you're looking at a trend that's been going on for a while, and all of a sudden you look at it and you say, hey, that looks really good, that should turn that switch in your head and say, oh, let me check, let me consider at least the possibility of a Climax. And if you want to quantify that looking really good, to my eye, it would be things like this: increasing slope of trend lines, larger bars with trendward closes, so meaning they close in an uptrend, close near their highs, and free bars. That looks like this. So that's a market that looks pretty good. Now, what do you do to trade Climax? The most important thing you can do, and good news is the easiest thing you can do here is just don't buy stupid with trend entries. Don't buy extended, and I'm a trader who primarily focuses on pullbacks, so to some extent I am insulated from this, but there are points, and by the way, I'll tell you right now, this is a point where I'm willing to buy stock index exposure at pretty extended points, and sometimes you have to do that to participate in a more extended trend. But you need to know the risk of what you're doing, and I think if you in general have a rule that you're going to avoid any kind of chasing of a more extended trend, that's going to help you. If you do choose to enter with trend, I want you to consider that one possible outcome is you buy this bar and then 3 days later it looks like this. So a lot of times traders struggle because we get kind of locked in to the regular ways of the normal ways that patterns play out. And we do need to remember that these uglier, more dangerous possibilities do lurk, and they're more likely in these climactic extremes. So if you are aware that there's the possibility, okay, I'm buying here, this damn thing could really collapse against me, that puts you in the right frame of mind psychologically. You're not going to freeze. Sometimes when traders get completely unexpected things, like they just don't know what to do and they can't act, and a loss becomes a huge loss. So if you know this is a possibility, it's going to protect you. You also can consider use a wide stop. You need to be mindful of the possibility of a gap and failure, and a lot of these things can be mitigated by either using a wider stop, maybe a slightly smaller position, or looking to this is more, maybe seems like more of a theoretical thing for any one trade, but if you're looking at a set of trades, taking a profit target to the upside, which you might not normally want to do, right? If you're trading in an extended trend, you could make a very cogent argument for not using profit targets and just sticking with the trend. But if you're in one of these climax areas, maybe you say, I'm going to use at least a partial profit target, because if let's go back to this. Let's go back to this example. Let's imagine you did the worst, well, like almost the worst possible trade. Let's say you bought the close of that bar because FOMO finally got you and you had to buy. And let's say you used a pretty tight stop. So if you'd done that, I think your 1 hour target might have been hit there, or maybe the next day. If you took half the position off and then you fell asleep and you didn't get out until like that collapse, you can't trade that much worse than that, right? That's still, it's a larger than 1 hour loss, but it's not a 4 hour loss. It's not a gigantic loss. Where if you just bought this and you didn't take your partial profit, and you still traded it that badly, you might be looking at 5 or 6 hour loss. I don't know. I mean, we figured it out from the chart, but the point is that taking that partial profit, ringing the register on a little bit, is one way to protect yourself when you're trading in these more extended markets. You also can consider here trading against the trend. And if you do this, you need to decide if you're going to wait for confirmation or do it without. And I refer to the cardinal sin of trading. What I mean by that is being on the wrong side of a trend and adding to, I'm a trader. Sometimes I will add to a losing trade. There are times to do that, but the thing that you must avoid doing if you're going to do that is you don't want to be in a trending market and have the market moving against you while you're adding to the position. A couple of questions here. So Ray says, what are ideas to define or quantify extended trend, a trend that's been going on for a while? You certainly could. I mean, you could do all kinds of stats with this, right? You could look at percentile lengths of trends. You could define a trend by various ATR and swing combinations. You also can do it by just on a discretionary basis, just looking at a chart and saying this trend is longer than most of the trends on the chart, or this trend is reaching. And we've done it both ways. Frankly, I don't think there's a lot of value for a discretionary trader in quantifying this too much. I've done work. I've never published the work, but I've done fairly extensive work looking at length of swings, lengths of trends, quantifying precisely the bull and bear market trade-offs in the S&P or the Dow going back through the early 20th century. I don't think there's really a lot to be done from that. And Mark also asked, how can the Keltner channels be calibrated to achieve the most optimal parameters? Well, what are you trying to achieve with them? That's the question, right? If you're optimizing for something, you got to be clear what you're optimizing for. And if usually when people ask something like this, it's like, how can I optimize them for best trading? Well, what's that mean? How are you going to use them? I would also not spend too much time on that. I think if you have the channels that are so tight, they're always hit, it doesn't really do you much good. An example might be, go set up Keltner channels and use 0.5 for the ATR. If I just hit on like every bar, if they're so wide they're never hit, try like 10 ATR. It's kind of crazy. Then it's probably not useful. I find practically somewhere between 2 and 3 tends to be a good number for the ATR. And you can sort of play with that. You can also play with the length of the average too. How you set these indicators is for a discretionary trader. Again, this is not, this is not a systematic tool, but it's a tool that you need to be consistent with so you can be systematic within your discretion. But the way I think about these indicators is that they're more valuable for shaping my perception than, it's not like I'm actually going to take some precise action because this indicator value is this. That's not how I trade. It's not how I think about them. So let's take a few moments and look at some historical Climax patterns. These are S&P 500 futures. They're also back adjusted. So if you go back and you look like in 2002, you're going to see there were actually different prices for the S&P at that moment in time, but the back adjustment keeps the patterns consistent. There's a I think it's called Roll 'em, guys. Maybe pull up, I wrote a blog called Roll 'em that talks about these futures rolls and how to do them and the different back adjustments. If people aren't familiar with futures contracts, it's probably worth reading that. So they'll drop that link in the chat in just a moment. Here is the S&P from December 2003. Now, this is a good example of a market that I would say is potentially climactic. Why? Well, we're seeing this slide along the band's trend. So that is something that, and I'll talk about this a little bit more later in the presentation too, it's something I think I missed in the first book. This is a trending pattern where you see the market go to the band and just hug the band and not really move very much in terms of like up and down swings. This is a trend of consensus. It's a low volatility trend. It also is a potential warning of climax, even though it is a strong trending pattern. And I'm going to page back through a lot of slides. I know it's not great practice here, but these there were lots of points here that were slide along the band's trends. And you certainly can see slide along the band's trends that continue potentially for years. So these are, I'm not, if anything, I'm saying look to position with slide along the band's trends. I'm not saying fade them, but you do need to realize that they are extremely vulnerable to counter trend shocks. Here is how that pattern played out. It doesn't take too much of a counter trend shock to get you decent weakness. And there's definitely something to be said for looking to play in these areas. If you do look to participate in these counter trend shocks, look, here's another one that really didn't go anywhere. What you need to be prepared for is the trend to reassert itself very quickly. And one of the best ways that I know to play off these counter trend shocks is to look for these reversal complexes. And that would have given you, that would have allowed you to position here. But of course, the game's over just a few bars later. Not every reversal complex. This I would say is a 3-bar reversal complex, which not a great one, but it also had very, very little follow through. So if you're struggling as a trader and you're focusing on like looking to kind of catch these little wiggles and trends, this is a really, really hard way to trade. And it's also very seductive because every now and then you'll get a big collapse. But I think most traders who struggle with this probably will find the results get a lot better if they think about trading another way. This is not the best way to trade, but it is certainly one possibility, one way to think about these climax areas. A climax can be a single bar. Look at this. So here's a climax that this kind of breaks some of our rules, right? This is certainly not. So we're looking at the bar that I highlighted there. This is not a mature downtrend, right? This is not an extended downtrend. This is not a downtrend that has reached multiple legs. What this is this is a single period, a single bar, a single day in this case, that shows climactic action. Do notice also there was a little bit of measured move in play here. So if you look at this distance, and I'm just eyeballing, so this did hit, and that's not that unusual to see something kind of exhaust or climax into a measured move target. But do be aware that most of my focus here is on climaxes and trends, but they certainly can be single bars. Here's a nice example from July 2005. One of the other climactic patterns that we see, and this is related to, I would not quite call this a slide along the band's trend. My thinking in real time, I can tell you pretty definitively, had I seen this in real time, what I would have been thinking was this action might be setting up a slide along the band's trend. So if you just look where my lines are, it's certainly possible that this market might have continued like that. This is action that frequently sets up slide along the band's trends. However, there's also another possibility here that, just to be clear, when I'm saying trendward, what I mean here is in the direction of trend. It's just easier to say than in the direction of trend. And what do I mean by leaning in the direction of trend? Well, look, so these bars, the trend is temporarily down, and you have these bars that are making lower lows, lower lows, lower lows. So this is not a normal swinging situation, right? We don't have highs and lows. You have market like pushing to low, pushing to low, pushing to lows. It's maybe what's been happening to the upside in stock indexes recently, maybe. And then I think it's a little bit less important on the other side, but look here. So you have lower highs, lower highs. Here's a higher high, but things are not fully consistent. That's what I mean by leaning. The bulk of the bars goes in the direction of the trends. This is potentially short-term climactic. And one thing you can do when you identify this action is you can look for, again, you're not thinking about fading this because this could be a slide along the band's downtrend. But once you see this bar, you now have upside momentum, and you can think about playing for upside follow through. In this case, it would, with proper trade management, you might have gotten a little bit of money out of this trade, but it was a difficult trade. Many of these tend to be. Three pushes. So the idea behind three pushes is you have a market that's trending, and then it makes three symmetrical pushes in the trend direction, and that typically marks a high. It frequently marks a high. I shouldn't say typically. The problem with three pushes is, as I said, it can easily be, how are you counting here? 1, 2, 3, 4. So maybe we were 4 pushes. 1, 2, 3. And I do think in reality, these things nest a little bit. So you could mark this as 1, 2, 3. You could call this all one push. Maybe this is 2 pushes, and then maybe you have your 3 or 4 there. But just be aware when you see multiple pushes in the trend direction, particularly if they're symmetrical, that can end a trend. Look to the downside here too. Let me erase those marks. Look here. 1, 2. That's not quite in the right place. Let me put it in the right place. That'd be more useful, right? 1, 2, 3. So there's 3 pushes to the downside. It's also not unusual to see, so here is maybe push number 4 or something. It's not that unusual to see a market kind of make a top and then climax into that extreme and have some variation of a double top, double bottom. A lot of those classical chart patterns that people talk about are really driven by these ideas. Here is another climax formation. Now, you might look at this and say, so just to orient yourself, here we are here. This is the same thing we were just looking at, but this is also potentially climactic. More 3 pushes here. And again, you can see this lots of different ways. Here is, you could zoom in here and see this is 3 pushes. You could see 1, 2, 3, and other counts are possible. So don't get stuck. We were also looking back here. Don't get stuck on what is definitively the right answer, because this is a concept. This is a concept of when a market makes multiple stabs in the direction of a trend, there's a very good chance that trend is reaching some kind of extreme. Other things that set up potential climaxes are overshoots. So you will add, and that's what we see here. A couple tests of a low. You can also draw, a very common pattern is to draw a trend line and to see that the market will try to capture beyond that trend line and will then be rejected. That's an example of an overshoot. Here's another example of an overshoot. You could draw a trend line like that. And I can't draw straight lines here very well. You probably would prefer straight lines on your charts, but this is the same idea. A little bit of climax into that reversal pattern, and not all of these, I know that these are, you're seeing lots of variations of these patterns, and some of them may seem to slightly conflict, but this is how it works. So the problem with Climax is that I think if you want to mark spots where this market was potentially climactic, I think you would find yourself, and this is off of the March 2009 lows, you'd find yourself marking a lot of climaxes here, and then the market just continues to rocket higher, more or less, for years and years and years. So if you do want to trade, I can't stress this enough, if you're attracted by the idea of finding these overextended points, the two most important parts of your trading strategy are going to be, first of all, risk management, because there will be times that you'll just be horrifically wrong and get more wrong, and that will happen. Doesn't kill the strategy, but you have to have a way to deal with it. And profit taking. Profit taking is very, very important. Here is another more recent climax. Actually, we looked at this before in a slightly different view, but you can see here highlighting that run up into the 2018 highs and the slide along the Benz trend. And then also there was climactic action here to the bottom. Again, not a climax set up by an extended trend, climax set up by extended momentum, perhaps some consensus, and then multiple overshoots near those lows. It also might be interesting if you want to do your own work to go back and look at some of these areas on lower time frames too. There's definitely information there. This is the COVID climax. So this is a very, very unusual pattern because I think you could make a case that much of this action, so this was climactic, this was climactic, this was climactic, over and over and over. But we were also in an environment where you also reasonably could have projected stocks much, much lower. So this is a case of multiple climaxes getting rolled over. And this obviously was not, in terms of time, an extended trend. It was in terms of magnitude. And notice here, this is hugely expanded volatility, but this is an example of those trendward leaning bars. Now, I do want to point out, as long as our focus here has been so clearly on climax, look at this. Here you have kind of a standard pullback, right? I say kind of because volatility was off the charts crazy, but you do have a tradable pullback pattern here. And this is, where if you were going to call this climactic here, the climax, all you got off of this was just enough of a bounce to get into a pullback. And where did you finally definitively realize that this was climactic, the market wasn't going down anymore? Well, this is the aftermath of this. So this is that previous chart cut off right around here. And you can definitely take the information from this climax and then look to use it to position in other reasonable pullbacks. And by the way, look here. This wasn't really the point of these, but look here, all of these little mini climaxes to the upside and fewer to the downside. So that wraps up our discussion on Climax. Let's see, look at the questions here. How do you deal with proportionality within the same chart and assessing trends? Similar to complex pullback being a higher time frame pullback, I'm seeing various proportions in trading. This makes it difficult to understand the state of the trend. I think one of the answers to that is just to look at a lot of charts and maybe more than like trying to come up with firm rules, to understand how flexible these proportions can be. People who like to teach and talk about ratios think that all of this is much more concrete than it is. But if you maybe a good place to start is just to have kind of two classifications. Have a market that's like very early trend, so might be just a few days, and then a market that's in a more established trend, and then you can work on like the super old trend as a third category. But I really think, and I know it's it's maybe a less than inspiring answer to say just you got to see a lot of data, you got to look at a lot of charts, but this is really something that drives to the question of why is this stuff so hard to teach? Because let's face it, compared to a lot of disciplines, what we're teaching here is not that complicated. Certainly for those of you who have medical backgrounds, anatomy, human anatomy is much more complicated, right? I would argue for, if I was going to teach you music composition, it's probably much more legitimately complicated. But what makes this so complicated to teach is that many of the critical understandings really can't be taught. They have to be yours. They have to be discovered. And maybe that's true in many other areas. Socrates would have certainly thought so, right? That this is really uncovering knowledge that you were developing or you had yourself. But the best way that you can learn to trade is to have some guidelines, have some structure. Maybe kind of have somebody have an experienced artist show you where the lines are, and then you color within the lines. And you got to do that a lot. You got to see a lot of data. In the book, you say you can take a complex pullback after a climactic move because the market has worked off the condition. Is this still valid? Well, of course. And I think we need qualifiers there, right? That you can sometimes take a complex pullback, because what the complex pullback will do sometimes is work off the climax. Look, it happened here, right? So there's your question, there's your answer right here on the chart. If you there's a potential long trade, right? Let's go back here where we're looking at. It's a good question. Let's go back here. So we know we're climactic here, right? So we're not going to look to short and then we have good upside momentum emerging. And our thinking is we're not going to look to short right away, right? Because this has been a huge, we had our simple pullback here. So my thinking at this point was, I can tell you, I was a little bit late to get the bullish message, few days, weeks maybe, because I was expecting a complex pullback. But what happens is you look at this and you say, that's not exactly consistent with a pullback. It's a little bit too much strength off of those lows, but we just been crazy extended. So, okay, maybe the market will stabilize. But then once you start to see this is where you start to get the message that, oh, this is actually not that weak. That this is not a point where I'm going to look for a complex pullback to short. So you see here, the action here really doesn't sucker us into a short, and the action here more definitively sets up a long. It's a good question. On the S&P daily, I won't go to a current chart. There's a failure test, an inside bar. I just recorded for our Market Life people to talk about this. This is just an area this is a very complex area where market maybe got a little bit ahead of itself. My thinking was heading into Friday that maybe we were setting up for a little bit more extended pullback, maybe even a more serious intermediate term sell-off, but we don't have any follow through on Friday, so it looks like it's probably just going to be absorbed. How relevant do I think it is to gauge volatility and look for a squeeze using Bollinger Bands or similar indicators to measure volatility? Colossal waste of time. Looking for a squeeze it's absolutely worthless as a timing indicator, gives you no information you can't get off of a chart. I don't see any validity whatsoever. Okay, so let's take a little bit of a break there, and then we'll come back and finally get to the main point of the chapter. I'll see you back in about 5 minutes. Okay, let's continue. So we want to talk here. The main point of the chapter is this interaction between trend to range, then back to, back and forth. And one of the ways to think about these areas, this is not in the book. So this is a new way that I have been thinking about these things lately, is to think about, you could plot various areas of price action. I don't know how precisely you could do it, but along different axes. One is how random is price action within that regime or within that environment. And I think what you would find is that action within trends tends to be less random, ranges tend to be more random. Persistence, meaning like how forecastable is it? Trends tend to continue. The reality is that if you look at a chart at any point in time, and this is very relevant to what we're about to do, your best bet is to assume that what the market is doing or has been doing in recent points is going to continue in the future, in the near future. Assume that the near future will look like the past. That's your good base case for what's the market likely to look like. However, even within that, trends tend to be more persistent than ranges. And then, of course, from this follows the reliability of patterns within these regimes. How reliable are the patterns? Patterns and trends are more reliable. So knowing all of this, I think you could make a very strong logical argument for focusing on trading trends. And that's why many traders do that. There's nothing wrong with saying, I'm going to limit my times I participate to certain areas of price action. If, this is the big if you can reasonably avoid other areas. Now, what do I mean by that? Let's say you're a day trader. Let's say you're a day trader who only trades trends. Fine. Let's go a step further and say you're an S&P day trader who only trades trending days. Well, what this means is that you are practically going to trade probably 2 days out of a week, or you might trade half of a day. So from a practical, again, standpoint, can you capture those days without making a lot of stupid trades on ranging days that don't really favor your play? So if your answer to that is yes, or maybe you're a day trader who trades stocks, so then you can go through and select stocks that are only trending, or maybe you're a swing trader and you can only pick times when the market is trending to be involved, then that's fine. But if that's not you, then what you probably need to do is to build some skill, understanding, and being able to participate in all of these market regimes. Time frame matters a lot. The psychological skills, I think this is something that is underappreciated. The psychological skills with respect to trade management are very, very different on different time frames. For instance, if you consider, I don't want to say swing trading, it's not a time frame, but like we all kind of casually use that as a time frame, right? But if you have a trader who holds things for days and weeks, and then you have a trader who's in and out several times in a day, with those two extremes, the intraday trader probably needs to have a hair trigger psychologically, meaning you get into the trade, if it doesn't look right, you're out, you're gone. Where the daily or longer trader really should give it the benefit of the doubt in most cases. Let's wait and see what happens. And also in these different regimes, there is a different mindset that's needed. If you are, for instance, trading with a trend, then that wait and see attitude is correct. Why? Well, it's just logical, right? If what I said on the previous slide is true and tend to persist, then if you think you're positioned with a trend, and if that trend is likely to continue in the future, then if your trade doesn't look great right now, maybe you should wait a little bit and see what happens, because that trend is likely to persist. If you are fading that trend, so if you're on the other side of that trend, then it makes sense to get out right away as soon as the trade moves against you, within some potential variation. Also, style, personality matters. Scalping is certainly the kind of ultimate expression of hair trigger, and you really have to figure this out for you. This is one of the main ways that trading style has to be shaped, or trading style has to be adapted for your personality. Everybody says you have to find something that works for you, and that's true. But then if that's all anybody says, that's like somebody dropping a fortune cookie on your desk and like you're supposed to figure out trading from some little saying like that. It's not really helpful. But one of the critical ways that you find yourself as a trader is to figure out how reactive you want to be. Well, is it want, need to be, are, versus these possibilities of trading styles, and then figuring out how that's going to line up. You've seen this before. We covered this in the very first, maybe second presentation. This is the kind of classic Wyckoff cycle. I relabeled it here. And now we can think about in this, the move from this trading range to trend is our classic breakout trade. And eventually the trend will roll over back into a range. And this is that transition, trend termination into trading range. So we should talk a little bit about that word. Everybody talks about trend reversal. And you get on Twitter or X now, I don't know. And you see all these people talking about looking for trend reversals. The problem with that language is if you tell me trend reversal is a legitimate thing. I've illustrated it as 0.3 here. Market's going up and it reverses into a downtrend. It happens. Doesn't happen very often. It's much more likely that the trend stops, trend termination. We could just as well call it trend stopping, but I guess termination sounds smarter. But the trend terminates and then the market just goes sideways into a range. And then it's possible that range is a consolidation pattern that leads to further trending. So don't assume if you are trading for a stopping of a trend termination, don't assume that you're going to get a trend reversal. It is one of the possible outcomes, but one possibility is that the trend will just terminate into a trading range. There are also, so these are the areas that we are talking about today. I'm sorry, let me go back to the previous slide. These are the areas we're talking about today. Let's also note there are others, and we've covered these. This is another way to look at all of the trending action we were looking at, really just trend continuing and range holding, range continuing. This model here with what is in gray and what is in red together, this is kind of a schematic of all possible price action on a very high level. If we dip down in just a little bit deeper, we start to get a handful of patterns. And these are the patterns that I want to look at today. Let's go through this, not necessarily in order. We've covered these in a little bit of detail. We're going to see these again, but not maybe as much as we did in Climax. I'm not going to talk terribly extensively about these, price rejection, price acceptance, because we've covered them in considerable detail in previous weeks. We do then need to look at these breakouts. So a breakout is any time you have a range that becomes a trend that is accomplished by a breakout. It's also worth pointing out that if you're a stock trader, you might say breakout and break down. You will tend to hear stock traders use the breakdown for the bearish trade. Futures traders, and that's since that was the crucible in which I was formed, I will tend to say breakout for either direction. So we'll look at breakouts. This is what we're going to do next here, and we'll look at the patterns before, following, and at breakouts, and also the patterns of both good and failed breakouts. So you can see there, this decision tree branches a little bit, and then we'll take a little break and we'll come back and we'll look at these trend termination patterns. All of these here on the bottom, these are your trend termination patterns, trend into range and into opposite range. So let's jump into breakouts. These are one of the easier areas to spot on charts. A lot of beginning traders start by trading breakouts, and I'll just go on record here and say I think it's a mistake for most people, particularly day traders will trade breakouts. Why? Because any day in the market, I'm going to be able to go and pull anywhere on a bad day, I'll be able to pull 3 or 4 stock charts. On a good day, hundreds of stock charts where I show you a little breakout. If you'd only gotten on board here with a teeny tiny stop, then the thing would have gone like 5,000 times in your trade direction. So it's a very sexy thing to see on a chart. It's easy to see on a chart. It's easy to sell to people this idea of trading breakouts. And also every good move did in fact start with a breakout. So, if you work your tree backwards, you'll find yourself thinking in a very flawed way there. Volatility can be high. This is really a problem because many times these breakouts that look look at the end of the day, you look back and you look, or we don't have to talk intraday. You can also look at these on the daily chart. At the time these happened, they were these gigantic moves with gigantic bid-ask spreads. Liquidity can be low. A breakout's a failure of liquidity. If you think about it, what the range really does, Wyckoff's composite buyers and sellers were kind of equally matched. There was good liquidity above, good liquidity below the market, and it just bounced back and forth there. And then what happened? If it broke out to the upside, the sellers failed. The sellers failed to provide enough liquidity. So it's a failure of liquidity, and that's what generates the volatility. These are very difficult areas to fail. And also, we should notice that most of these do fail. Most breakouts fail. We'll see this in a moment. Typical pre-breakout patterns for good breakouts. Higher lows, and this is straight from the book, into resistance or support. And that's what we have here. See these higher lows, or in the case of the breakdown trade, lower highs. Tight range near extreme, and that's what you have here, this little like sub range, which can just be a few bars sometimes, and pre-breakout accumulation or distribution. So we can look at shadows, wicks, reversal complexes, things like that we've talked about in previous sessions. What do we mean by good breakouts? We also should define this. Let's not just casually look at charts and say, oh, that's a good breakout. It's very important that you have your own definition, but I will offer 2 here. One's a breakout that hits a profit target. Now, that's problematic, right? Because how are you setting your profit targets? And these become a little bit more useful when you think about pattern geometry. So what I mean here is, if we were, for instance, here, like you might enter here. Sorry, you might enter here, and your stop might be somewhere here. So then your profit target might be, 1, 2, or 3, might be some ratio of that. You also could enter here and have a stop here. So then your profit target is reflected above like that. And there are different ways to do this here. Like maybe your entry is this line. I've already marked the stop as being the bottom of the range. So your target is here. Or you could use one of these smaller swings or something like that. So chances are you're setting your profit target based somehow on the geometry. It's a little bit problematic to use volatility. A lot of people will like to set stops and targets based on volatility, but the problem is, if your breakout is good, the volatility in 2 or 3 bars is going to have very little connection with the volatility you've just experienced. Because what happens here in these pre-breakout areas, sometimes the market kind of winds down, and somebody asked about the squeeze. The volatility really does get low. Now, the reason I said that the squeeze wasn't really worth thinking about is that there's no timing implication at all. Volatility can go very low, and this thing can just stay with low volatility and not go anywhere forever. Doesn't mean, oh, it's got to explode now. It's going to, no, it's not true at all. But this contraction of volatility, look at it here. You see it here kind of casually in this, like if you just look at the length of swings here, getting smaller and smaller, that's also volatility compressing. So if you're measuring your stop and your target based on like an ATR function, it's a little bit difficult, I think, to make that work before a breakout. The other definition of a breakout, which is my number 1, which of course I did second, but that's just the way my brain works, just breakouts that have significant continuation, which we also probably would think of in terms of geometry a little bit. Patterns at good breakouts. So good breakouts typically see real action and sharp volatility. I put this in the book. Slippage is good, meaning that, like, particularly if you're a day trader and you go to buy at a breakout point and you get a shitty fill, so you get slipped way beyond that breakout point. That a lot of times that's a really good sign for your trade. Not always. Sometimes it just sucks, but you know, that's what you're looking for. Why? Because, well, that showed there was a real failure of liquidity there, and you know, it can also point to some execution issues, but not always. Sometimes it's not your fault. It also is worth pointing out, I didn't make this clearly enough in the book, you'll see many breakouts that do start slowly. There are breakouts that, you know, you can always go back and say that's the point on the chart where the breakout happened, but not every breakout is this, like, you know, that they flash the lights and drop the confetti and say, here's the breakout. There are breakouts that kind of like slip beyond the level and then they just begin and gather momentum. This is not very well captured in the literature of technical analysis because it's not that interesting to look at or talk about, and it's very hard to show good chart examples. So I guess my point is, and maybe this is a little bit of a refinement from the first book, it's a little bit difficult to categorize action around breakout points as being like, you know, really good action or not great action. Pattern following good breakouts. Well, I got bad news for you here too. Everybody thinks that this breakout level is sacrosanct, that it can't be broken. But if you do just a little bit of a casual study, you will find that this scenario here, so the breakout happened here, and then on the pullback went below, or in this case, above the breakout level, that this set of bottom scenarios here, these tend to work out pretty much just as well as these that have what we would call the good action. So I think it's a mistake based on my you know, considerable experience with these things. I think it's a mistake to buy this pullback and to put your stop at the breakout level and to say, I'm just not going to play if it comes back to the breakout level. It's not a great way to manage these trades. Patterns following failed breakouts, kind of the classics here are a failure test. This is where we do see a lot of the good failure tests, and a counter breakout pullback, a snap pullback, or what I called an anti in the book. There is always a trade-off here between gathering information and trade position, meaning basically you get in early, because think about it, with any good breakout, the best place to buy is before the breakout, by definition, right? But the trade didn't exist at that point. So it then becomes a question of how much confirmation you're going to wait for. Are you going to buy at the instant of the breakout, or are you going to give the thing a little bit more time to move to the point where you have a little bit more assurance is happening? So this is my only slide that I know of that I have an error, and the action that we're talking about here, this box that's drawn here, really should be here. So this is the area that we're looking at. Let's go back here and look for the last couple years now at the S&P and look at breakouts. This is a breakout trade. There is pre-breakout accumulation here. Not impressive, right? But you do see these lower shadows, and then you have your breakout level here, holds higher, and notice does come back, violate the breakout level before continuing higher. Now you have a question when you're thinking about trading breakouts. Are you trying to capture this, or are you trying to capture this? And of course your trade management will be radically different for the two, but if you're looking at breakouts, you have to be clear what your objective is on these trades. Here's another breakout level. So minimal follow through to the upside here, and then we have a downside breakout. And notice right away stopped by a reversal complex, and you're back up in the range with 2 bars. Now, this is, what is this? This is a counter trend. So this highlights the difficulty of saying, is the market ranging or is it trending? Where this box is highlighted, I would argue it's both. Depends on your time frame. It is trending up here, and it's ranging for a week, for what, like 6-7 days there. And so this breakdown then was counter to the higher time frame trend. You could have made the bet that the trend was going to break down and the market was going to collapse, but this is typical action. Particularly this unprepared. What do I mean by unprepared? We didn't have any of this. Had we had some very small bars here, a few more bars there, it would potentially set up a better downside breakout. Just showing you a lot of breakouts here. This is the goal. This is a very complex breakout area. There was preparation Here's a little bit of preparation. There was accumulation at the lows. Notice there was a failure at the breakout point and well down below the previous breakout level. However, then stabilized, and maybe there's a second trade. This is very typical of real market action. Nobody's going to put this in a textbook, right? You know, those, sign up here and get my free PDF ebook. I'll show you like the 7 best chart patterns. This is never going to make that. It's never going to make that book, because this highlights how difficult, dangerous, and ugly trading can be sometimes. But if you're going to trade, you got to wrap your head around this stuff. You have to be prepared for this kind of action and think about how you might trade this. Another chart here. None of these really are ranges. You could potentially maybe make a case, but all of these really look much more like flags than ranges. And maybe that is starting to look a little bit rangy. And let's actually ask that question. So is this a range? This is, one of the ways to think about a range is to look for the market to make a trend extreme here, and then look for the market to make a downside move. So what you are at this, the problem with this is if you apply this strictly, you're going to apply it to every pullback. You would have done it here. Look, market makes an extreme. Here's the low. What happens when you come back up to that extreme? Well, we just head higher. Okay, so then here, the market makes an extreme, comes back. So then I'm watching this as potential range, but we just go through the top. Okay, market makes an extreme here. Here's the low. What happens when we come back? Well, we just go through the, oh, do we? Well, not really. At this point now, it's looking like we've maybe extended upward here. So what I would do then is go back and start to pay a little bit more attention to this point. And that's why this catches my eye a little bit more than this. Is this a range? A little bit clearer here, right? So I think I would draw the range something like this at this point. Notice here is another unprepared breakdown. According to every principle of technical analysis, what happened? Let me go back here. What happened here? This is a climax, right? It's a single bar selling climax into a support area, and the market appears to find support and bounces quite strongly. I would tell you, if we were just looking at a number of patterns, that this is probably most often not a good short under that bar. However, in this particular case, it did turn out to have pretty good follow through. And maybe you had a chance to enter under this bar. Certainly hit profit targets, very limited time, big reversal complex, big climax. Look how much bigger the volatility is here. Just look at the range of this bar compared to the range here. This is mid 2019. Going forward a little bit, where's the range here? So look, here's the trend extreme, the downward trend extreme, and then you have this reaction up. So this is the level you watch, not this, not this. These may very well turn out to be important, but this is the range you're looking at. You have here a little bit of a consolidation higher. You might argue that this is higher lows into this area. And yes, I am aware, of course, this is a lower low, but the concept still holds. And you had a little bit of a consolidation here. So this is a decent prepared breakout. Look at your measured move target from here to here. Not quite achieved. I said achieved-ish, not quite. You, at worst case outcome, if you had waited to buy late following this breakout, you should have scratched the trade. Should certainly not have been a loss. Look at this. Is this a range? Not really a clean one. I think if anything, what's really going on here is a pullback and then downside failure. You might have looked for it to establish a range, but this is a good example of at some point this volatility exhausts itself, and then you just start to have this kind of grinding climb higher. Range or not here. You can treat this as a range, even though it's probably a bit of a pullback, and a pullback, as we know, is kind of a range, right? Little consolidation near the highs here, nice prepared breakout, good standard breakout, good follow through. Look at this action here. So this is the same area which I've marked two different ways. This is, and this follows the previous chart a little bit. You could see this as a range, as kind of an expanding range, and you might even wish to take your lower confine of the range down there. If I see a single bar like failure of that, I won't usually do that. I'll continue to watch this, but I would consider this to be a range. Or do you treat this as some kind of expanding pattern? Either read, I think, is correct, but one of the issues to realize here is that relatively tight ranges many times will have bars that completely go through the range. So, I showed you in the previous presentation, we were talking about ranges, and we were looking for ways to get short here and then get long here and kind of trade this bounce back and forth within the range, which you can do sometimes. But also you need to be aware that some ranges look like this, where the complete range will be filled. Sometimes every bar will fill the range. You'll be able to define a range as not really having any tradable swings on that time frame. Yes, there were probably lower time frame swings that were tradable, but on the trading time frame, the bars just fill the range. There's not really a lot you can do with it. Okay, look at this. Something wicked this week comes. So this market's now been trending for a while. This is, but every snapshot that I've just shown you, we just move forward in time a little bit. And let's actually just go back and kind of play through these again. So just the point, the market just kind of keeps going higher and making ranges that keep breaking higher. But we're starting to see some warning signs. We're starting to see a lot of counter trend momentum. And one of the questions is, how much counter trend momentum can be absorbed? And when you do start to see a lot of counter trend shocks lining up, that is one of the warnings that the trend might be running into some serious trouble. What's really interesting is when you see counter trend shocks that are absorbed so well, and consider the the emotional pendulum, right? So you see these counter trend shocks, now you're a little bit worried, but then they're absorbed so well. Now you're feeling good about the trend, that the market continues to go higher. Now you're feeling good about the trend. Can you guess what happens next? Into climax. That's a nice pattern. And when you see that, so when you have this climax that was preceded by a decent amount of counter trend stuff that, think about it kind of challenging the trend regime, that is a good warning that something may be setting up. And this was, in fact, early 2020, and we got this action that we already spent some time thinking about in terms of climaxes. So I don't really think there are any ranges here. This is a flag that I already marked. Do notice, look how significant this range looks here. And now look, as the volatility expands, this is the same area that's still highlighted, right? All I did was just rescale the chart forward, and you have this range that looks like a big deal on the chart. All of a sudden is dwarfed by the emergence of the new volatility. Is this a range? Is it a pullback? Is it a range? If you follow my plan of looking for a potential range, you're watching for it here. And then as the market developed a little bit more and you got poor upside follow through here, this is where you started to become a little bit more convinced. Notice here, this is a good example of that consolidation against the upper side of the range. This was a quite tradable breakout of the upside of the range. If you trade technical patterns and if you traded the COVID collapse, this was the point where you absolutely should have gotten the message that the market was no longer bearish. I think it should have come earlier. I don't remember exactly when we got the message. I think it was somewhere in here. And I was frustrated that we missed a couple weeks, but it was very, very clear here after you had this pullback resolve higher, after you had this reversal complex that was absorbed with no downside shock, after you had a little bit of internal support there, a little bit consolidation, break higher. Now, the other thing I would want to point out here is that this is not an impressive breakout bar, right? This is the breakout bar we want. Like, you just want to see like this boom, like, massive explosion to highs, but it does not always work like that. It does not have to look like that, despite the fact that a lot of books tell you it does and it has to look like that. It's just not true. Here is a little bit further on, some significant counter-trend volatility that's absorbed. Notice we don't really re-challenge this low. We turn up from this here, a little bit of a consolidation higher. And again, this is a different chart, but this looks quite similar, right? You have this same kind of garbage. Like, look, failed breakout-ish, I don't know, failed breakout. Failed breakout. How many failed breakouts here? 5, right? And then you have a good, then you finally, after all of that crap, you have a good breakout, and then it crappy follow through the next day, and then it fails, and then it's back into the range. So if you are, and what you will see is like a lot of people will show you trade examples. And why am I saying a lot of people? Because what happens is then I should connect this dot. When you're doing your trade review, it's very tempting to then speak like those lot of people and to say, oh, of course I had to get out because it failed on the breakout. But what my point is, this is just not reality. This is not the way the world works, and pattern's a little bit complex. Look here. Here's a much wider range. Look at this. How's that for a failed breakout? And then you have this breakout pullback that comes back below the range. If you don't get anything else from the from this presentation today, the one thing I want you to take away from is that anybody who tells you a good breakout has to hold above the breakout level does not understand charts. There's just no way to hold to that statement with an awareness of how markets really work. I can't say it any nicer way than that. Is this a range? Maybe. Maybe not. You should be alert to the possibility on every one of these pullbacks, the possibility of range action. Look here. Now, the issue, of course, is that at some point, these failed breakouts start to line up. Look here. That's a little bit of a failed breakout. That's a little bit better one. Here's a pretty good failed breakout, right? And then we have bounce off of the bottom, reversal complex. That's a really nasty failed breakout. So this looks, and then you have this unprepared downside break that we've talked about, right? But then this stabilizes into a much larger range. You saw, if you think you saw this chart earlier, you did, but just to see it again here in a slightly different context. And again, notice first of all, the number one shitty breakout, followed by the utter failure of a breakout, and then the massive reversal, and then the quiet, unassuming breakout that's the one that works. If you don't know this is the way it works, trading's very frustrating. Here's a good example of a range that is completely filled by bars. Many of the bars in this range cross through the range. There's very little opportunity to set up trades there. These are often in very low volatility conditions, as they say here. They also can happen when the volatility is expanded. You might argue there's an earlier range somewhere here too. Is this a range? So this is late 2021. I don't think so. I think you need to, if you're thinking of this as a range, you're looking at a breakout here, which you do eventually get, but I think the real message here was this accumulation off of the lows. So thinking of it as a range then gave you motivation to look here. By the way, does this look like anything else? Have you seen this before? You have. Look what happened after the COVID lows. You'll see different scale, but very similar price action. So really, here's a point where even though I would be very hard pressed to defend the idea that this is a range, but thinking in terms of the range, and just to be clear, this does not belong here. This really should be anchored here. I drew the box to this anchor point. But the anchor points for the range are here, and then initially here, but we just traded lower, so you got here. And I said I don't tend to use these climax points as range extremes, but in this case, the climax point was the range extreme. It's not like it was a test of a range extreme. Do you understand the difference? If you have the previous low and then you wick down to it and through it, I won't necessarily move down under that, but in this case, that actually did mark the range extreme. And then we had, and that's why I didn't move the range down here. Things to think about there. Here is a failed upside break that led to a downside break, a lot of volatility. If you used a profit target, this would have been hit. I guess another emerging lesson here is that, and this is very prominent right now in social media, everybody's trying to short stocks, and you certainly can. You can do it very well, but there's a time to do it, and it's difficult to do. So another range, this is a pretty good example. So you have if you're really looking at the evolution of the range, you first were drawing from here, and then you moved higher here, and you pretty decisively broke through that. We just talked about that earlier. So then the range moves down here. So this is how this range has evolved. And then you're watching here, you have a failed upside break here, and then look, you have, boom, there's the bar, right there it is. This is the breakout bar that everybody wants. Good momentum, good follow through. This is the one to put in your textbook. And then the market is able to consolidate higher. The breakout pullback consolidates higher. Look at this, we turn up and we've not penetrated that range. However, here's what actually happened. Then we decisively fail back into the range. Just kind of page forward here. We look to stabilize. This is early 2022. Looks like maybe setting up. This was a very, very tradable pattern at the time, and good reason to be short there. Here's the good signal, is either the failure of the top or when you blast through the bottom of the range. This is clearly shifting you into bearish mode, and here is here's the follow through from that. So that is our little talk on the dynamics around breakouts, the reality of breakouts. Let's take a little bit of a break here. We will come back and do a little bit more work and wrap up. I'll see you back in about 5 minutes. Okay, welcome back. So a few questions here before we go on. If I want to catch higher lows into resistance pre-breakout, can I try to catch the inflection point by going to lower time frame, look for failure test or loss of momentum, a lower time frame? Can you? Yes. One possibility certainly is to look to be positioned before a breakout. And excuse me, it does not have to be an either or thing. You know, like one possibility is you get half your position trying to literally accumulate. So, you know, there's where that word comes from in that pre-breakout phase, and then buy the rest on the breakout. Or you can play games like get your position and then sell some on the breakout. So, which is what, you know, the kind of the model says a lot of the big players do, and then look to buy back. And there's a lot of different things you can do. You might not even have to go down to lower time frame like that. You could use structure on your trading time frame. Is it a 60% penetration back to the range after the breakout still a healthy breakout? I would say that's probably, you know, I'm assuming you mean like you're going 60% into the range. That's a pretty big pullback into the range. In most cases, that would probably, I would think that would violate the range enough that, you know, not to say that we couldn't kind of reset and then look for another trade, but that probably kills the breakout. My point was that it's just not that that breakout level has to hold, and sometimes it can't even be penetrated significantly, and the trade's still good. So think about mental skills. There are real problems here, and these areas, more than some others, highlight the need for flexibility. Right? Meaning that you look at where you're wrong, like what we were just discussing about. Sometimes even maybe willingness to flip positions. You can be a trader as a rule to not flip positions. I very rarely will flip a position, but if there's certainly times it's appropriate to do so. And one of the ways that I think about it, one of the things that's challenging psychologically is every time you put on a trade, you have to have a strong opinion, right? You have to say, I am sure enough of my read that I'm going to risk my money on this trade. But then what happens? You get just a little bit of conflicting information. You have to say, oh, okay, I'm wrong. And that's not a very natural way for people to think, because it's much more natural to say, yeah, here's my point, and I'm going to argue, like, how do you argue points, and just dig in deeper and to find more evidence to support where exactly the opposite is needed in trading. You get the right amount of contradictory information, you immediately change your opinion, or at the very least admit you're wrong. And decision fatigue is real. What I mean by this is that, you know, in a breakout, like think about some of those breakouts we looked at where like not good, not good, not good. Okay, now it's good. Now not good, not good. Now maybe it should be that. Okay, now it's good, right? So, you know, some of these breakouts, if you were looking at the very finest level of market action, you might be looking at 8 or 9 decisions. That's a lot of decisions. That's probably more decisions than a person can reasonably make. And at some point, you just start to get kind of punch drunk, and it's very hard to persevere. Grit is really important. There is academic research on grit. You can search the word perseverance, and you do have to find that balance between, you know, as I say here, there's a balance between not giving up too soon, and on the other hand, being like so stubborn that you crash your trading account into a big smoking hole in the ground. And there definitely is a balance. And this is another one of those aspects that I think has to be tailored to your personality. Not everybody can trade a system where you might have to switch your opinion a lot. And if you can't do that, then these types of patterns are patterns that you probably should avoid. And if you know that about yourself, then the good news is there are a lot of other patterns you can trade, just probably not these. So this is why knowing yourself and understanding, not looking at optimistic, idealized pictures of price action, but understanding how messy this stuff can be will push you toward the kind of trading that you can really do that's right for you. And a lot of this comes down to wisdom, because perseverance, you know, really sticking to it can look a lot like stubbornness, and sometimes it can cross that line. And any any example that, unless you do a study very carefully where you're looking at every single pattern occurrence, even what I've done today where I've tried to show you a variety of patterns, there's still a little element of like my judgment, like I'm not going to show them that one or that one's a good one. And and certainly anything in teaching material from books, it includes this element of resulting, and that's a term. If you don't know that, you should look at Annie Duke's books. We've talked about this before, somebody drop a link to her book in there, please. Good traders are wise traders. You do want to cultivate wisdom, and one of the things that you should think about is you work through your trading journey, and particularly when you start to get those first stages of success, so you really get the idea of, hey, I can do this. And the question becomes, can I keep doing this for years and years and years? And you want to think at that point, like, how can I develop the wisdom to become the trader that I know I can be? Continuing with our pattern menagerie, looking at these trend failures. Let's jump into these. We won't look at these in quite so much detail. So here are a few historical detail or historical examples. So this is an uptrend that reverses into a downtrend. I don't think there's really any super clear tradable pattern here to my eye. Here is a climax into an uptrend reversal. So the clues here were the multiple momentums. Let me go back. I said there are really no clear tradable patterns here. So certainly, we've touched this example a couple other times in the slides. You can highlight things like 3 pushes. And if I were inclined to do things like, I'm sure I could draw some kind of trend line here and show you an overshoot. I'm sure I can show you, if we zoom in on these bars, look at a lower time frame, there's some lower time frame 3 pushes. There's got to be some kind of RSI divergence or other nonsense. There's no reliable pattern, because to my point earlier, you would have seen the same pattern over and over and over without it having this forecasting value. And here, however, I do think you had a little bit better evidence. You had certainly this shift of upside momentum. You had the climactic overshoot, and that gave you some warning of a possible reversal. Here is the point where we looked at the failure of the trend into range. Momentum just failed. And by the way, this idea that I showed you, which I don't think I've really talked about much before, but of looking at each of these points as being a possibility of a range. So let's highlight this one just again. So here, now you're looking at these points, but we penetrate this enough that you're like, okay, I'm probably not really going to look at that. And then you're looking at this new high, and then you're looking at maybe down here. Or you might also consider here, but I think I'd probably go down there. And you penetrate, but not enough to be interesting. So you're like, oh, okay, maybe here's a range that we will watch. So this is where it finally does settle into a range. And you can see there's also a rollover of momentum. This is the relevant downtrend. It's not much, it's what, 5 days, but here's a very short-lived but extremely volatile downtrend that leads to a climax reversal. This is another way that, in this case, look, this is a nice example here, Adam, thank you. So here's example number 1 of a trend turning into a range by losing momentum. Here's the polar opposite, where you have a trend that exhausts into, like, forest fire, scorched earth, nothing else left to burn kind of downtrend that then exhausts back into the range. One of the other things you need to be aware of, whenever you have a sharp momentum move followed by a sharp momentum move in the other direction, the most likely outcome from that is some kind of consolidation. Whether it will actually triangle or range, I don't know, but it is not super likely, and you should go back and look at the other examples from this presentation. It's not super likely that you will have that example of a strong momentum move, and then you will have huge continuation in either way. Usually you're going to see the market needs to do some work before something really happens here. Here is, and again, we've seen this action before. So here's a small uptrend. So now we're talking about this is the uptrend, and then this rolls over into a pullback, but this pullback fails. And there's really not a whole lot of satisfaction for the counter trend trade here. I'll go forward to the next slide. So, this is that area. This ends up turning into a range. Failed attempt to reverse. And even though in this case, like this is a lot of downside momentum, the uptrend does continue. Uptrend continues into a moderate overextension. So moderate overextension down here, and then by the time we get up here, we're also slightly overextended. There's a similar failure here, and as we pointed out, I already talked about this before, so I don't need to spend a lot of time here. But typically trends that can absorb these kind of counter trend shocks are very strong trends. Now, here's a trend reversal, and this is why. This is the kind of pattern all the trend reversal people are playing for. We finally found one. We found a market that was cleanly trending to the upside and just collapsed into a roaring downtrend. You've looked at a lot of data today. How many times have you seen this, right? This is not common. It happens, but it doesn't happen enough to, let's say, hang your hat on. And we looked at this area too already, but just to point out that if we're thinking about now our thinking is trends turning into trend reversals, turning into either opposite trends or just terminating into range. We have to think about this in that context too. And you can see all of the climactic action here, and then we talked about the evolution through here, that this at the very least showed you there was a pretty good probability that the market was at least not going to continue down. I think at this point you could have made an argument that we were transitioning into, at the very least, I keep saying this, this is not super bearish. You come up, you've engaged the upper channel, you're consolidating higher, and just realize that you can look at any chart. Like if you want some reason to short this, okay, what's a reason to short? Double top, right? Not a great one, but you're always going to be able to find some reason to do whatever you want to do. But the real issue comes when you think about how you prioritize all of this and how you think about this in context. That's why we spent so much time in a previous presentation thinking about context. Here is another classic climax, little parabolic-ish move. And in fact, you did get the parabolic collapse there, a little trend reversal, but not much of a trend reversal because it just transitioned into a range. So point being, if you're playing for this kind of move all the time, you're much more likely when you win to get something like this. You just gotta plan for that. Here's another example of a climax, a little bit of a move here, a little bit of a consolidation. So this is also one, and this is one reason why trend termination is so seductive to people, because this is the way trends work. You will get to these temporary minor climax overextension points. And maybe you want to say, okay, it's not, Adam, it's not a climax. You're probably right, but it's a lower time frame climax, and it's certainly an overextension. And those are the points that really just set up your best pullbacks. And that's why I said, I've said before, there's kind of this Goldilocks zone where you get enough with trend momentum to set up a pullback, but not to exhaust the trend, because not everybody is on one side of the trade. You got to think about this. You have to be aware that good, healthy, normal trends move to these points of overextension. And if you're not aware that this is the standard playbook, then what you're going to find yourself doing is getting excited about doing exactly the wrong thing at the wrong time. Continuing on here, here's another, this is that previous climax that you can see failed into not much of a downtrend. We could talk about different kinds of three pushes here, but pretty clearly, at least a little bit exhaustive to the downside. Here you had the emergence of an uptrend. Again, reached a minor climax, had a pullback. This pullback failed. And once you start to see all of these crappy failures, it becomes obvious that, hey, maybe what we're really dealing with here is just some kind of more extended bigger range. Here is another example of a trend termination. I know I'm going fast, but you'll probably need to spend some time going back reviewing these, I think. Market peels away from this upper band, just losing momentum. This case doesn't really lead to anything, but perhaps because this is a relatively new uptrend off of those lows. Lots and lots of reasons to look for reversals here, but I think you do start to get, and yeah, I'm not making this up, like this is stuff we saw in real time. My eye was very focused contextually on every time the market went down, we had all of these big lower tails. And this was pointed to consistent buying pressure underneath the market. And that's a refinement. It's not strictly in line with patterns, because I think if you were just looking at patterns, there were opportunities for reversals, but it definitely made sense to lean fairly heavily to the upside. And finally, after all of this very confusing, very conflicted action, another thing here, this is a little bit unusual, where at least with the way I calibrate the bands, that we cross all the way through the bands. It happens, I mean, it happened here, but it doesn't happen a lot. And that's a particularly loose kind of market. Now look, finally, here's a market that looks good. We've grinded through all of this crap, and we've now moved into a clean trend, and now we're making a nice pullback. So it finally looks good, right? Well, guess what? This is some evidence also that the risk reward is shifting, and that point was here. And notice your 3 pushes here, some minor climax, and at all of these points, even this doesn't really get us very much follow through. Definitely worth looking at the way that wicks align, just to raise this point again here at these major turns, and then look here up to the upside too. So you would go insane and not make any money if you were to focus exclusively on trading these wicks, and some people do. I think it's their entire YouTube channels about this stuff. Doesn't work out of context. In context, it's very powerful. And lining up with these other tools, it's both one piece of information, and it's also confirmation. Here's a good example. We saw this before into the last session here, or the last section here, that this is a good example of a trend change by a big picture structural pullback failure. So, this is, you have all of these pullbacks, and all these pullbacks can indeed be significant. Here was this bigger failure. Is it starting to look familiar? So, I'm also tricking you into just learning the history of the S&P, right? But having this, what I mean by structural here, was this breakout point, this very significant breakout point that we looked at that led to a major trend change. So, summary. Just to kind of review everything we did here today. Perception is suspect. Beware of your own built-in error correction, optical illusions, etc. However, when you think about this, you're going to find yourself thinking yourself into a lot of holes, into a lot of back alleys. It's going to become very confusing. The razor that will simplify all of this is to focus on what is useful and what works. Now you got to figure out what works. You got to figure out what works for you, figure out what is truly useful. But I think a lot of these questions of validity and reality are, you can cut through those and essentially just reach for the apple and bite into the apple because you see the big shiny red apple there, right? It's the same, but you probably do want to think a little bit about some of the quirks of perceptions around support and resistance, and around levels, and potentially around generating patterns with your brain where no patterns exist in the market. We looked at real world patterns in probably more depth than you wanted. We looked at all the complexity and noise and misleading ability of these patterns. But even with all of that, we also saw there is also valid structure. There really is a there underneath these patterns holding all of this up. And this is, I didn't really highlight this point here, but I analyzed and traded all of this stuff in real time. And I have videos recorded every day where I did, day by day, bar by bar analysis. So I'm not just like going back and making stuff up. I got things wrong at times, but this is market history that I lived. It's market history that's very tradable. This is not just something in books. Continue with the summary. So I want to turn here in a moment and do a summary of the first part of the book. But Climax, we talked about, you can know when to suspect it might be likely, but you cannot identify it until after the fact with 100% reliability. It also exists on a spectrum. It's not a clear thing saying this is climactic. It's appropriate to say this is a little bit climactic. This has elements of climax, and to assess the probability of potential counter trend action based on the strength of that climax. We're going to cover the rest of those patterns here in a moment, but this is just kind of to review everything here, big picture. I won't necessarily read all of these slides to you. This is from the end of this chapter of the book, but the kind of the highlights here are you have to have an edge to make money trading. And our edges are driven by imbalance of buying and selling pressures, which we've talked about in extensive detail. And this interaction of buying and selling pressure manifests as these two forces, mean reversion and momentum. I think that this is something, I think I was the first person to write about this, and I think this is something that people should think about a little bit more. There really are only 4 possible technical trades. There's trend continuation, there's trend termination, and then there's support and resistance holding or failing. Every trade you do is some variation of one of those categories. You might potentially draw from 2 of those categories sometimes, but there's no technical trade that's not captured by this structure. If you understand how your trades fit into this structure, and then you understand how this structure interacts with the market cycle and the market phase. What I mean by that is the market trending? Is there any reason to think this trend might stop? Or you can change whatever. This will show you where to apply your specific trades. Market structure is relatively static. It refers to the structure we see with lengths of swings. To some extent, it refers to some of the chart patterns that people talk about, but I really think that it's the kind of the skeleton underneath those patterns. Price action is the more dynamic element. I would argue when we're looking at things like wicks, even though those are, obviously they're static, they're on charts, but those are the more dynamic elements that's leaning a little bit more toward price action. And there are 3 critical areas of market structure, which we've talked about a lot today. This is what we focused on today: trends, trading ranges, and then what happens between those 2. Trends tend to move in a series of with trend impulse moves separated by retracements. You also know now that trends tend to reach minor climaxes to set up those retracements. Retracements that are basically trading ranges, but they're in alignment with that higher time frame trend. Again, I'm not going to read everything on the slides here too. Trend terminations are usually set up by, this is something from the first book, and I would actually disagree with this in terms of utility. It's true that you can, if you look at trend terminations, they're usually set up by either some kind of lagging, I almost said flagging, but that's bad, some kind of like rolling over or reduction of momentum, which reads as a momentum divergence, or by climax. But I don't think that's particularly useful when you go to actually set up trades, because momentum divergences is, the joke is that it calls 20 out of the last 5 reversals. So you'll have so many false signals that I don't think that it really is something you can use. Trend termination trades without clear evidence of change of character, unless you're trading off of extremely climactic points and you know what you're doing with very small profit targets. This is critical. Trends can terminate into either trading ranges or reversals, And we saw many examples of this today, right? The trends can end either with this kind of, flagging momentum, as I was saying, and I don't mean flag in like the chart pattern flag, or into parabolic climaxes. Trading ranges defined by support and resistance zones. I showed you a way today with looking at the structure as the market develops. That is not in the book. That's something that I haven't really talked about much before. Typically, we do see accumulation and distribution patterns, wicks essentially, and reversal complexes at these extremes. Do be aware that when the range is broken, doesn't necessarily mean you're going to have a breakout. Sometimes the range just gets bigger. Breakouts we talked about a lot, typically volatile, sometimes can be quiet. First pullback after a breakout is critical for assessing the strength of the trend, but it's not necessarily set in stone. Breakout failure is more common than successful breakouts, but even defining the breakout failure, if you're doing it based off the relationship to that previous breakout level, is a little bit difficult to do. So that's the end of our presentation here today. I will do questions. If you have more questions, this is your last chance to get them in the box. Are there any good rules of thumb for dealing with the messiness of trend to range and vice versa, such as 2 losing trades? I'll demand a cleaner, more convincing pattern. The answer to that, I think, really comes from no, it's a more personal answer than a broad answer, I guess. So are you a trader who, what you really can't do, what I think it's pretty obvious you can't do, is take like 8 full-size losing trades, right? That makes no sense. To take 8 full-size losing trades in preparation of a breakout, and then the breakout finally happens and you make 2R and you're down 6R, and that math obviously does not work. So that's not going to work. But what if you were in a situation where you were able to take many but much smaller losses? You could potentially have multiple times at bat before the breakout really happened. The question then becomes, what works for you psychologically? Can you have those losses? Can you just kind of roll over those losses? Or do you suffer from decision fatigue? Where do you start to get frustrated? Where do you start to make mistakes provoked by losing trades? That's the question. I don't think, I think you've seen today in the complexity of these patterns, which I know is a little overwhelming. And I imagine at this point, a couple hours into this presentation, you're probably feeling a little intoxicated, right? This almost overwhelming complexity, it makes it impossible to give a simple rule like that. But having said that, let me reemphasize that you do need behavioral rules for yourself that will shape and determine your action. Here's another question. Roughly the percent of failed breakouts against successful breakouts. I won't do a casual assessment of probability like that. I just don't know. I have quantified it in certain market regimes, certain time frames. I don't think that, if I say a number here, you're going to go forward with that number, which even though it was true for one specific slice of data I was looking at, I think could be extremely misguiding. So misguided. What you should do is answer that question for yourself. That's a great study. It will take you just a few hours to do, but go and accumulate breakouts and score them. And you obviously, one of the other issues here is, as we covered in the course, what's a successful breakout? And you have to have the answer for yourself. And then you'll need to be very consistent with how you score those. The stats you come up with are better. If I say a number, it's just going to be garbage. How do you actually develop a trading system around these patterns? Just look at charts, or do you actually do some quantitative analysis? If the latter, what software? So I use several pieces of software for quantitative analysis. I do quite a bit. I use about 4 pieces. The software you use doesn't matter. It's like, programming, what language you're going to program. It doesn't matter. You have to get the job done. You should use whatever you're comfortable with. I've talked about this before. What's more important than software is understanding basic stats, understanding what you're trying to do. So you don't have to have like this deep toolkit of advanced math. What you do have to have is basic math, basic statistics, but at a very deep level. So you have to really understand it. You have to understand what you're looking at. You have to understand if you're going to use a significance test, what are the issues with those tests? What assumptions are being violated? How how robust is the test to the violations of those assumptions? So it's not elementary understanding, but it's also not super advanced math. As far as developing systems around these, I mean, that's a separate thing. Our framework here is systematic trading within a quantitatively supported framework. So I've done, the way I typically will do tests is looking at various elements, and rather than taking a whole system which says we get in here and then we like get out later, at some specific date or on some specific criterion, to say, here's the condition, and then you look at returns for a window after that, and you aggregate those and you look at that against the baseline drift, and you get some idea of whether this thing does tease out a valid pattern. And then you can do, the actual back testing can be figuring out exactly how I'm going to trade these things, and then doing extensive back tests, whether done with code or manually. There are pluses and minuses for both of those, but I think you probably ideally would do a little bit of both of those. But we're not talking about, if you want to take like these concepts of Climax and develop a system around them, what you have to do is put a rigid quantitative framework around them, which is going to some extent, there's a richness of analysis that we can do here that is discretionary traders that is necessarily lost in the heavy quant work. And it's a different kind of scene. And so it's a little bit out of scope, but it's a good question. If you want to trade them as a discretionary trader, you still need to have some understanding of possible outcomes. Is the last gasp pattern still a valid trend reversal? I think I would call several types of Climax a last gasp. So I think that's certainly something that I would consider. That's not something that has changed in any way. As more and more markets work, typically last gasp, you think about maybe being connected with trend reversal, trend termination. You think about it, being a little bit more associated with gaps, and more markets are pushing to toward 24-hour trading. If you don't come up with a quantitative definition of a climax, how do you know you see one when you think you see one? Well, what have I just done for 2 hours? And I've talked about, like, this is kind of the whole framework of discretionary trading. And I suspect that it actually, you can clarify if you want with a question, is your background, are you coming from a quantitative background? If so, this is a different approach. It's a different way to see. At the risk of talking about this for hours, I have covered this. And does anybody remember, team, where I covered this in the previous Hudson session? Could you maybe drop a link to the timestamp from that previous? I think maybe it was last week. So it's definitely a matter of training your pattern recognition. And if you want to set up a quantitative structure, you absolutely can. But like I said, it's a significantly different way to see. I'm still not able to wrap my head around finding a statistical edge and proving that it works using back testing and still be a discretionary trader. How can you back test a discretionary system? Well, Tim, did you also see the previous Hudson sessions? Because I did talk a lot about this. It's interesting, we're getting kind of the same questions. So back testing, what does back testing mean? So back testing can mean two things, kind of two exactly opposite things. One, it can be completely rule-based. When I have this precise set of conditions, I get into a trade and I buy this amount, or sell this amount. And when I have these conditions, I get out of a trade. Completely rules-based, and then you just run the code and do that. That's one kind of backtesting. Backtesting can also be for a discretionary trader to go back and to train your pattern recognition. Now, there's still an element of when I see these conditions, I will make this decision. And if you're correct to say that discretionary backtesting is not as precise as quantitative backtesting. It's a different thing. It's for a different end. It will not be consistent. If you gave a good discretionary trader the same backtest on 2 different days, they might come up, or might not, but I would expect they might come up with some different decisions. And and you're like, okay, well, if it's different, it's just a waste of time. No, not at all, because it's a question of how different, right? If it's just completely different, if you're looking at a chart and you're just making like different random decisions every fucking day, then you're not doing anything, right? Then it's nothing. But if your decisions are largely consistent and there are some differences in the details, that's the reality of discretionary trading. With that element of human discretion, you are going to make slightly different decisions. Now, the quantitative people absolutely, emphatically, wrongly will argue that what I just said completely invalidates the trading approach. The reality is that a skilled discretionary trader will outperform a systematic approach. It's more difficult to learn to do. It's more difficult to maintain because you are a critical part of that system. But you're doing the back test to, first of all, as I said, I think of a discretionary backtest as having a few pieces. One is that tendency backtest, which seems to be very difficult recently for people to understand. I feel like people have understood this for many, many years, but there's some discussions in the Discord. Maybe this is partially where this is coming from, where people are finding this difficult to understand that what we can do is say, when we have this condition, when we have, for instance, a market that has gone up according to certain criteria and then has pulled back, there is a statistical edge for the trend to continue. If we can identify that, that gives us big picture quantitative framework within which we can set up discretionary trades. That's one kind of backtest. Another kind of backtest is then to go through and to do a very detailed pattern look at what decisions would I have made on historical data at that time. So then you're training your pattern recognition, but you're still not just looking at a chart and saying, oh, I feel like shorting. No, you're doing this with awareness of this structure and framework. And everything that I've been talking about here comes from that quantitative work that I have done that shows the structure and framework. And this is why, many times you'll see people who talk about things and they'll I'll point out things and I'll say, other people think this is significant. I don't. It's because I haven't been able to find a statistical edge there. And, people will see patterns that I don't think are supported quantitatively. And your work might lead you to different answers, but it's a very different way to, it's a completely different way to trade. And where I think where I think the disconnect is that if you're working from a purely algorithmic systematic trading approach where you have an absolutely fixed set of rules that never deviate until the system is reoptimized potentially. If you're working from that framework and then you're looking at the discipline of discretionary trading, you will say that discipline of discretionary trading is so loose that it's invalid. Well, it's not invalid, but it's different. It's the, I don't really want to get too caught up in the difference between art and science, because I think both aspects of trading, systematic trading has a huge dose of art in it. Discretionary trading should have a huge dose of science in it, but maybe the balance leans a little bit more certainly towards subjective elements, because it contains the word discretionary. So certainly it's a good question. It's worth thinking about quite a bit. And if you come from an engineering background, these people struggle a little bit with this sometimes. And if you come from a system trading background and you're looking at discretionary trading, what you just have to realize is this is a completely different thing. Because if you think about discretionary trading from your system trading perspective, it is nonsense, but it's not nonsense. It's the problem, the question, the frame. So that wraps up for today. Thank you, everybody. I appreciate your time and focus. I know asking people to come spend a few hours thinking about deep elements of market structure is it's a big ask, and I certainly appreciate your time. And I'll see you back for another session soon.